why crypto and technology is such amazing investment opportunity.
Bitcoinzilla stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad, Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoinzilla today and enjoy the new edge. Raoul presents insights on the future of money, Bitcoin and Trump's macro playbook, exploring digital innovation and political liquidity. Watch to uncover how these trends will shape our future.
The first thing I'm thinking is obviously breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TGA until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. How do you measure this shorter-term funding dynamic? In what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense, but does it get captured elsewhere? Or do you have to just look at bill issuance in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the talk. But basically, what that shows is my estimates of what I call not QE, which is what Jay Powell does, and which is the TGA and things like the rundown of the reverse repos. And you've also got on top of that the other bit that I've called not yield curve control, which is unconventional funding. And that is something like about together, they're adding something like about 6 trillion to stimulus. Now, the way that I've done that is to look at a concept called dollar duration and to look at how dollar duration has changed and put that in liquidity equivalent terms. So that's how I estimate it. And that's really against a normal funding benchmark. The skew has been quite noticeable because as you understand, Treasury bill finance has gone up hugely. Bills have been a large proportion of what's funded the deficit in the last 12 months. And on top of that, Janet's skewed the issuance calendar away from long-dated coupons towards shorter-dated ones. And she's taken about a year and a quarter on average out of the average, Treasury auction.
Does that change the debt refi cycle? Or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be short cycles are shortened, and they're going to have to, they're going to have to start pushing a lot more liquidity back more immediately. That may be the issue. We know that Scott Besant's got to fund 30% of the deficit 30% of the outstanding debt this year.
Yeah. Even if he moves out further duration, the market won't take it without liquidity, whether it's, some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Yeah, exactly. And I think this is the reality, because if they don't add liquidity, who's going to buy this debt, this coupon debt? And we know the structure of the Treasury market is itself quite fragile because, foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, as you will remember, they're fairly fickle, or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem the Treasury market could face, a spike up in yields. We're doing pretty well at the moment, aren't we? Yields have moved up quite smartly anyway.
Cathie Wood, the renowned founder and CEO of ARK Invest, shared her compelling insights during a conversation with Valerio Baselli. Wood's discussion touched on a range of influential topics, including Musk's role in electric vehicles, Trump's impact on politics and crypto, DeepSeek's breakthrough in artificial intelligence, and the evolving landscape of Bitcoin. Her report, Big Ideas for 2025, reveals her strong conviction in transformative technologies and long-term value investing. Wood explained that DeepSeek's remarkably low-cost AI model is following the industry trend of rapidly declining development costs, much like what has been observed with OpenAI and Anthropic. Despite some uncertainty around the true investment behind DeepSeek's breakthrough, the trend toward lower costs continues to drive innovation. At the heart of ARK's strategy is a focus on portfolios built for a 5-year horizon, with an emphasis on deep value. She also addressed the challenges facing electric vehicles, noting that while political entanglements, such as Musk's associations with influential figures, may cause short-term hesitations, the economic advantages of EVs will ultimately prevail. Moreover, Wood sees Bitcoin as a revolutionary global asset that mirrors the transformative potential of the early Internet era. Cathie Wood's vision reassures investors that disruptive innovation, whether in AI, EVs, or digital currencies, will create profound opportunities. As these sectors evolve, her dynamic approach to managing risk and seizing value remains at the forefront of ARK Invest's strategy. Wood's candid insights underscore a belief that thoughtful innovation and patient, long-term investment can transform industries and improve lives.
Yeah, there's a lot of moving parts for Scott Besson to now navigate. I guess drawing down the TJ helps in the interim, but then they have to figure out something more structural for them to do this. But that sort of times with Basel IV coming in as well. Do you think this new administration will follow the Basel IV thing? Because I think it's in place in Europe now, or at least starting. And then the UK.
Yeah, there's talk about delaying it, but I mean, generally they're moving faster than the US.
And that to me just seems another way of just forcing banks to hold more of the bonds.
Yeah, I mean, that's all it is. Yeah, exactly that. I mean, this is financial repression sort of in practice. I mean, this is what's going on. They need more and more people to hold the debt. But I think the fact is they're running out of safe hands. So ultimately, the central banks are going to have to do it themselves. Particularly if they're moving away from bill finance. I mean, the one luxury that bill finance offered was that the banks tend to buy that stuff with alacrity. But if they're not issuing bills, they're going to have to get people to buy coupons. And that demand is not really there. You may well have read, but there's been a lot of disquiet among pensioners against their pension fund managers to say, why on earth are you putting 20, 30, 40% of my fund in bonds? And bonds, remember, have lost, 25% on average of their value since 2020. So, there's pushback there. So the pension funds don't really want to hold too many bonds. So the only safe pair of hands you can think of are the central banks.
Yeah, or the banking system, as long as they don't have mark-to-market. Yeah, exactly. And you can stick it on Jamie Dimon's balance sheet for quite a period of time.
Bitwise CEO Hunter Horsley and head of Alpha Jeff Park are buzzing with excitement over Bitcoin's potential. They argue that the world is on the brink of maximum chaos, and all signs point to a major pump in Bitcoin prices. With a massive debt limit increase on the horizon and escalating trade tensions, these macroeconomic signals, combined with hints of central banks flushing markets with cash, create an environment ripe for dramatic shifts. Both executives see Bitcoin as a generational opportunity. Despite a slight dip recently, the low volatility levels suggest that the digital asset is undervalued compared to its past potential. As traditional markets face unpredictable challenges and political moves, such as aggressive trade policies, the stage appears set for Bitcoin to break out. With growing mainstream interest and evolving market dynamics, investors are advised to keep a close eye on Bitcoin as the world navigates through these turbulent times. If you've been with us so far, a big thank you. Don't forget to subscribe for free to Bitcoin Zella for your daily news. The link is waiting below. That's all for today's crypto news. Stick around for more updates, insights, and analysis on cryptocurrencies. Share your thoughts in the comments, like this video, and subscribe for more exciting content.